we want to try to talk a little bit about the reality of what we've talked about here, because I know there's a lot of information, and I know you're all sitting there saying, how do we apply this? And what's become very obvious is that you need external help. What you need is someone with engineering background, construction engineering background, to assist you in taking the positions that you take, and in doing so, giving you some relative security as it relates to what if we're audited, what if we're reviewed, what are they going to find, what are they going to allow, what are they going to disallow. And I think we would all agree that this is a lot of new information. And how we got here was not, the commissioner didn't roll out of bed one day and decide to change these regs. What really happened was FedEx brought a case against the tax court because they felt that it wasn't reasonable that they had to capitalize things that were repairs. And so they felt the same as you do. Why do I have to capitalize a roof for 39 years when it lasts 10? And so they just happen to have the money and the time and the attorneys to get the IRS to court, and they won. And so when the IRS loses in a court situation like that and they have to acquiesce a position, which in this case goes back to the early 60s. You know, we've been depreciating and capitalizing these things like this since that time, and it hasn't been challenged. And it took some time to wind through the courts, but in response to the loss, they had to issue what Lewis refers to as that revenue procedure. And that revenue procedure is important because, and again, you didn't get a postcard from the IRS about that either. You know, they didn't send you a thing that said, hey, great news, you've been overpaying for the last 15 years and we're going to give you that money back. No, it's out there, and those of us in the industry, I can say that, you know, we're busier than we've ever been. We're hiring engineers as fast as we can find them, and I think Mike back there told me he turned in 200 schedules this week. So that means 200 buildings that people own, that they have things capitalized, that they now want to expense, and more importantly, they want to expense repairs going forward. They've turned those schedules into us to review and analyze and tell them what their savings are, what their forward-looking capitalization policy should be. That's a big deal. It just means that opportunity has been created. At the same time, other folks in Washington are working to raise taxes. We don't think they're related, but it is uncanny, the timing. But this is a huge drawdown for the Treasury. So the opportunities are, first of all, to follow the rules. I mean, they're saying, put these buildings into these systems. And you're asking yourself why. And the reason why is, if you haven't segregated it into systems, and next year I want to replace the roof, and I want to take advantage of what really is a taxpayer-friendly rule. I'm one of the ones that feels like everything that happened here is friendly. Probably because we are so deep into it and we've been actively doing this for 3 years now. And we were all very thankful when the final regs were issued that we didn't have to go back and redo the last 3 years' work, because a lot of taxpayers took advantage of the proposed regs and said, hey, this is going to be the way it is. Well, it looks different, but the real crux of it, the real property, the portions that we are concerned about, isn't that much different. In fact, all of those examples, in one way or another, contradict themselves. If you look at them close enough, you'll find one that says one thing and one that says another, correct? If any of you have read them all, and a few of us in here have, it only leads us to believe that it's all subject to interpretation in facts and circumstances. So the prudent clients, our clients are CPAs. So we deal with CPA firms all over the country, and by extension, we help their clients. And we show them how to take a position that they're going to be able to prevail in an audit. And together, in tandem, ASL and our firm, for example, when we do a study on a group of buildings, we agree to support that up to and including the appeal process. So if the IRS challenges it, you've got our firm of 300 people and 60 years experience, Lewis's firm, all at the table at one time. So we're helping. The idea is bring it current, put yourself in compliance, probably put some money in your pocket. On the average, we found that if you've been following a reasonable capitalization policy, in other words, if you've been doing it somewhat like they've been telling you to do it, somewhere around 10 or to 15% of the net book value of your real estate portfolio consist of things that were capitalized that now no longer have to be. So whatever your net book value is times 15%, perhaps is the amount of deduction you could take this year to comply with these regs that you didn't know you had to comply with. So as opposed to costing you money to comply, it actually puts money in your pocket, and it changes the picture going forward because now you're expensing things that in the past you've had to capitalize. So along with that, obviously if you're going to pay an engineer to go out and look at your portfolio, why not look at everything within that portfolio that might make sense from a tax advantage that requires an engineer? And so we're going to talk about that a little bit. Things like energy efficient building renovations and new construction. There's been the Energy Policy Act around since 2006. And it's a pretty good deduction. It's up to $1.80 per square foot for things within a building that are efficient systems. But keep in mind that the statute for that was we had 3 years to capture that. But they changed that very quietly. Didn't get that postcode either. About a year and a half ago. And now we can go as far back as January of 2006. So we can bring forward all those energy tax deductions under the same scope of work as complying with these regs in one big basket. So that's pretty neat stuff there. And then as you've made improvements, the other side of this is, what I'm really kind of talking about there in bullet point 7 is, yeah, there are some portions of the new regs that are questionable. And that betterment stuff that Lewis did so well telling us about, you know, some of this betterment stuff is very subjective. I mean, is a new HVAC system of higher quality than the one I took out of there? Well, I hope so. I mean, that's why I bought it. So what the rule says is if it's clearly a betterment, let's say it's a geothermal system and it's definitely better, we can abandon at book value the system that we replaced. And I mean, those systems are all very valuable. The method of determining the value of the system is based on a construction estimation guide that the IRS recognizes that is really based on today's costs. So a 10-year-old HVAC system is, per the IRS rules, again, I don't make the rules, I just know how to follow them, it's costed out today's prices, minus accumulated depreciation. I would say a good rule of thumb is if you spend $1 on a betterment item, you're probably going to be able to write off 60 cents of the old item. 60 cents worth of that dollar, because the way they calculate an HVAC system through the construction estimation guides has not been updated lately. People are buying buildings that would cost $5 million to replace for $3 million. I'm estimating the cost of that HVAC system at the $5 million rate. So the yield for abandonment is higher than it's ever been, and we're selling more abandonment studies than we've ever sold. I know you're all going, I didn't know you guys sold abandonment studies. I've been looking for one of those, you know? And we have some out in the car. But the thing is, the abandonment study wasn't that popular in the past because it was, you know, people thought, well, that's a lot of work. I'm going to knock down that wall, and to calculate what the cost of that wall is, I've got to get an engineer out here, and they're going to tell me how much the steel studs are and how much damage it did to the floor and how much it was to put the ceiling back where the tiles are removed. But if we're out there anyways, and you did that 2 years ago, and you still have a set of blueprints, we put that in there too. So all of those things can be reviewed in one big study application. So the idea is that going forward, we want to meet the regs. Going backwards, we want to fix what we did wrong, and we don't want to have to get caught in the process. So the review by a third party of everything that you've done can be, at its best, can be an arduous task, but the idea is the better the records that you've kept from your contractors, historical data that you have, an inspection of the facility goes a long way. So any of you that have bought a cost segregation study knows they kind of fall into two categories. You got what we call a desktop study, which is $5,000 and here's your numbers and we drove by the building or we looked at it on Google Earth. And then the other side is a detailed study where we've been there, we've seen it, we've worked from blueprints, we got your contractor documents. The yield on an engineered study is usually about 25% higher. So those folks that are buying those $5,000 studies don't really realize how much they're costing themselves. So the idea is it's the same type of scope of work, is to do it and do it right and bring everything up to current. So what he talked about earlier was the 3115, which is the accounting method change, which is an automatic approval. We don't have to ask permission anymore to do this. And so there are a lot of them out there. Cost segregation was approved for this some years ago. That was a big win because prior to that, if you did a cost seg study, you had to take that catch up over a 4-year period. And what that means is, if you bought a building 10 years ago, well, you bought a building 5 years ago for $3 million and you didn't cost seg it, if you chose to do it, you had to take those savings, which would be roughly 20% of $3 million. So you take that $600,000 and you take it in equal splits over 4 years. That was great, except in year 2, if you went out of profitability, you didn't need it. You paid $25,000 for a study. Now what's happened is, they've changed that where whatever the catch-up amount is, that 481A adjustment amount, you take it all right now. The study prices have come down because it's really become more of a mainstream item. So a $25,000 study is today a $15,000 study. You're getting to take it all. We got an energy study you can do at the same time because you replace the HVAC 2 years later. So we go back, we get that, we add that in the 3115, and now along comes 263A, which is approved. So an opportunity exists to go through and look at everything that's been done probably in the last 15 years. Because on your residentials, you got a 27.5-year recovery. On your commercial, you got a 40-year. Anything that's been done in the last 15 years still has basis, still has the opportunity to accelerate, and you can still justify paying a fee to get that money today. So the idea is, in bullet point 2, now we have the things the way they're telling us they have to be. You know, now when we finish with your building, it looks like what the IRS says it should. We got the 9 building systems defined. We have the personal property defined, so your 5-year items are there, your 15-year items are there, your 39-year items are there, and you're in, basically you're in compliance and getting paid to do it. See how much happier this is? Everybody's happier now. What did we do there? Well, we made a typo. So the adjustment was $6 million. The idea is, so here's the folks that owned these apartment complexes. They had $53 million worth of net book value. And within there, there were things that were capitalized that shouldn't have been. They can now be expensed because, again, what Lewis is saying goes both ways. That's the nice thing about it. We're going backwards. That means if you did it wrong, they can catch you. But if you did it and it wasn't to your advantage, you can now correct it and make it to your advantage while getting yourself in compliance at the same time.
You said that was a $6 million adjustment you guys had?
Yeah, we got a comment and a 0 missing. Publicly held company, $800 million worth of assets. 27 states, you know, a lot of things that were capitalized that didn't need to be capitalized, but $82 million adjustment. So again, that 10% of the book value and changing the picture going forward. You know, things that traditionally had to be capitalized, some cleaning activities, some FDA activities. They didn't know how else to treat it. They were capitalizing it. Now clearly they're expensing it. I wanted to jump in early on this tugboat thing because something Lewis said made me think about this, but this is a great job that allowed me to spend an inordinate amount of time in Louisiana. So what we did there, we took $80 million worth of tugboats that were rebuilding of the power plant, which in a tugboat, again, you know, we're back to that unit of property thing. That tugboat is considered the unit of property under the new rules. So to rebuild a tugboat engine is $1.2 million on average. And there's 2 engines on each boat. This guy had a huge fleet. It's a privately owned business. He was capitalizing. At the same time, he had to get a 5-year certificate from the Coast Guard to keep these things in the water. And that required certain maintenance activities that he had to do just to keep it operational. Well, under the new regs, they specifically call out those activities that are part of a regulatory process. So all of these things that they were capitalizing now became expense. Where we had to draw the line was if when we rebuilt that power plant, we increased the horsepower, which goes back to what we were talking about, increases the strength, the efficiency of it, That had to be capitalized. But if we go in and we're just putting new rings in it, rebuilding the top end of the engine, putting a new cylinder head or rebuilding the cylinder head, and when we get done with it, it performs like it did before it fell into a state of disrepair, we expensed it. Great opportunity, very happy client. Went through a very large audit as soon as we turned it in, but they were auditing him every year anyways. We had a no change. It was just very well done, but it was a very comprehensive approach. But without an engineering aspect, we ticked and tied every invoice back to every scope of work on each tugboat, had it all into a spreadsheet analysis, and just gave it to the IRS. Here it is. Have fun. So a nice adjustment. So the idea with 263A, again, we couldn't have planned it, but by saying we got to break into components leads us back to that cost segregation thing. And so we're going to talk a little bit about it, but I think it's smart to look at your entire portfolio, to bring it all current, maybe save some money while you're doing it, and change the picture going forward.